So looking ahead to markets in the week starting January 27th, this is it. The week has come. Britain is finally leaving the European Union. There's no doubt about it at this point. The Brexit bill has passed the Commons and the Lords. It is happening this Friday, and celebrations or lack thereof will be taking place around midnight on Friday. It's not a big impact for the market. More importantly for markets is that we have two central bank meetings that will be widely watched. That's from the Bank of England and the Federal Reserve. We also should have the conclusion of Donald Trump's impeachment trial in the Senate, and we have some big company earnings. There's a lot of those big FANG company, popular technology stocks in the US, including the likes of Apple, will be reporting earnings, and that will be a big driver for overall markets. Now, in terms of the market's backdrop as we head into this week, maybe you're not getting bored of me saying this, but again, we saw more record highs last week. Actually, US indices did pull back a little bit from the record highs over concerns about the coronavirus in China. But actually, the DAX index from Germany hit record highs for the first time in a couple of years. So signs of a bit of outperformance in Europe was obviously well received from this side of the pond. In the currency markets, there was a lot of volatility in the British pound. Rate expectations ahead of this monetary policy meeting that we're about to discuss were all over the place, thanks to economic data showing one thing and policymakers saying another. Similar situation in Australia, but not quite as extreme. We saw some really good jobs numbers from Australia, even with the wildfires taking place there. So that's a good sign of the resilience of the Australian economy, and we saw some big Aussie strength off the back of that. The dollar's been more muted. Maybe that'll change after this Fed meeting. Gold has been holding its own above that $15.50 per ounce mark. Oil is still gradually sliding its way into new 2020 lows as of last week. Now, let's switch gears to the economic calendar coming up and the highlights that we can expect there. So we'll leave the Fed and the Bank of England meetings aside for now. I'll discuss those in more detail in just a second. But we do have Aussie inflation to look out for after that, as I mentioned, positive job surprise last month. It's GDP numbers from the US and the Eurozone. So they will again speak to this idea about whether we are, how bad the growth had slowed into the end of last year, and what chances do we have a bit of a growth rebound this year. Certainly stock markets, you can argue, are pricing in a growth rebound. So the worse it looks at the end of last year, the harder it is going to be to rebound from, obviously. And we also have Eurozone CPI data, which will be interesting after the ECB meeting last week. So first and foremost, let's just talk about the Federal Reserve, one of the central bank meetings that we have this week, and it is actually the first one on the calendar. It's on Wednesday. And the Fed have basically signaled as of their December meeting that they want to hold interest rates as they currently are at 1.75% for the rest of the year. As they say, they are satisfied with interest rates at current levels, and so now we have to ask ourselves the question, well, is there anything that's changed which might change that outlook from them? In a single word, probably no, but here are some considerations. When the meeting was held in December, it was before the US and China had signed the trade deal. So if the Federal Reserve were concerned at all about trade at that point, you could argue they should be less concerned now. And if they voice that sense of less concern, if you like, about global trade, then that would be naturally a positive indication about what they want to do with interest rates this coming year. The other thing is employment. We've had a couple of pretty dire non-farm payrolls reports. Remember, the December report was 145,000. I mean, not the end of the world, but certainly below expectations, and the report before that was not so good. So do they voice some concern about the slowing labour market in the US? Again, seems unlikely. The unemployment rate's at a 50-year low, so it's hardly a sign of weakness. But again, depends which way we want to swing on this. If they do voice some concern about it, that would be negative for the dollar. So there's various factors in which the Fed could emphasize here. Our feeling is that they'll probably be cautiously optimistic off the back of the trade war. But what they've said before is that even though they're looking to hold rates steady for this year, the bar to raising rates is higher than the than what's required to lower rates. So unless we see 2% inflation, above 2% inflation really sustained for a while here, probably even close to 3%, it doesn't seem likely we're going to get a Fed rate hike. But at the moment, things look okay enough that we won't get the cut either. Bank of England, I mean, I've talked about this a lot in the daily notes sent out through email. There's been all sorts of toing and froing, but the upshot is that started with Mark Carney, the governor of the Bank of England, a couple of weeks ago. He basically started talking about the fact that Bank of England have 250 basis points worth of room to ease policy. Obviously, the interest rate is 0.75%, so that doesn't make a lot of sense. It only makes sense when you think that actually other policy tools can be used to ease policy, like quantitative easing and negative interest rates and the like. Why was he saying that? Well, he's obviously concerned about the state of the British economy. He thinks there's a risk that we don't quite get the Boris rebound that people are hoping for after the election, and maybe Brexit uncertainty drags on the economy finally. Most economists aren't of that opinion, and the Bank of England seem pretty finely split on this. Hence, this is one of the more interesting meetings we've had for a while from Bank of England. They've literally kept interest rates to pretty much the same level since the financial crisis. It's been dull as ditch water, but actually now there seems to be a bit more of a fine balance. Some of the members sitting on the fence, and so all to play for until Thursday for what the different policymakers say and also for the data comes out. But our feeling is that probably while some may want to cut rates, probably including Mark Carney just before he leaves the job, he wants to make a mark before he goes. My sense is they just don't have the justification to cut interest rates in the UK when we've actually just reported the highest level of employment, lowest level of unemployment on record. So that's not really an environment in which you normally cut interest rates, even if inflation and the growth outlook look a bit uncertain. So switching gears from central banks, the other thing to look out for this week, again, was Donald Trump's impeachment trial. Things seem to be changing all the time here. There's constant wrangling between Democrats and Republicans. So the timeline that I'd actually set out in last week's video didn't exactly pan out. They changed it after I'd recorded the video. So actually the way things are working out is there's 3 days in which Democrats are putting the case to impeach Trump, and there's 3 days in which Republicans are choosing to rebuff it. But given, again, like we've said lots of times, given that there's more Republicans in the Senate than there are Democrats, it seems more than likely the president be acquitted, but we'll know for sure next week. And maybe there'll be some sort of bombshell testimony or something of that ilk that gets Trump impeached. It seems unlikely, but that's still entirely possible. So while those central bank meetings and the impeachment potentially are market movers, also worth mentioning the company earnings that are out last week. I've got it written down here. We've got Apple on Tuesday, that's the 28th, Facebook and Microsoft on Wednesday the 29th, and Amazon on Thursday the 30th. And of course on Friday is that Brexit day. It's been baked into the British pound and other British assets for a while that we are indeed leaving, but it's just still worth noting that is the date in question, Friday 31st. But thank you very much for watching this video, and if you do enjoy them, please make sure to follow myself and LCG on YouTube and social media.